Good evening, everyone, and welcome to tonight's FDU Alumni Webinar Series, brought to you by the FDU Alumni Association, the Office of Alumni Relations, Silberman College, and our corporate sponsor, TD Bank. Tonight's topic is market trends, inflation, and the changing economic landscape. As always, we thank you for taking your time out of your day to join us. And at this time, I would like to introduce our Executive Director of Alumni Relations and Development, Ken Lamb.
Good evening, everybody. Hope everybody's doing well. As Jen mentioned, really great topic tonight, market trends, inflation, and the changing economy. Before we get started, I just wanted to kind of give everybody quick update on some of the things that are happening on campus. First and foremost, President Capuano recently announced we have a new university provost, Michael Arvitroni, who was formerly the dean of the School of Pharmacy and Health Sciences. Provost Arvitroni was instrumental in helping to get the pharmacy school up and running and established at FDU. And so we're really excited to have him in this new role, overseeing all of the academic areas of FDU. Just announced a new 5-year partnership, an immersive residential program with our Roxton College campus and the Royal Shakespeare Company, where students will get to study abroad and work with the Royal Shakespeare Company and, around the works of Shakespeare. Alumnus William Ox, a very awesome guy who just recently was the project manager for NASA's James Webb Telescope that was just launched into space. It was launched on Christmas Day, and it successfully finally reached orbit on January 24th. So if you're doing the math, it takes a month to go up to outer space. And then also in the last fall, we had a new animation lab that was recently opened, made possible through a generous donation of a donor. Our athletics programs, Knights Athletics. We have construction is underway for a new student athlete academic center in the library on the Metro campus. And also this past fall, we officially launched the men's volleyball program, and we're looking forward to launching the women's lacrosse program in 2023. Over on our Florham campus, our fall sports finished the season strong with all winning records. 5 of the teams made it into the postseason. Football won its first ever bowl game. So we are bowl champions in football. Also, we had ribbon cutting ceremonies for several new athletic fields, including a new multi-purpose track and field complex that will be home to a variety of our doubles athletic programs. And we also have a new baseball field now over on the Florham campus. Looking ahead to the spring of 2022, we're cautiously optimistic for more in-person alumni activities. As much as we love Zoom, there's nothing to be said about meeting folks in person. We are looking to do a women's basketball pregame for the women's NEC tournament. Right now, FDU women's basketball is #1 in the conference, and they have secured a top seed in the tournament. Dinner on a show on April 2nd over at our Florham campus. And then also our alumni clubs and chapters are looking to plan some more in-person events throughout the spring. As I said, these virtual events are a mainstay now. We will be continuing doing these, including the webinars. Including we have on March 30th a student alumni networking event that's happening virtually. All these events can be found online. Go check it out, learn more, register, volunteer, and just come on out. I think the last 2 years we haven't really had a chance to see anybody, and we're looking forward to seeing you. Tonight we have 3 great panelists and an awesome student moderator who's going to help us throughout this evening. We have John Budish, class of 1977 BA and MBA in 85. He's currently an adjunct faculty member in the Silberman College of Business. He has extensive background in the financial industry, and he recently started the Budish Group, an angel investing firm. We also have Kevin Mahn, class of 1993 from the MBA program, who's currently President and Chief Investment Officer for Henyon Walsh Asset Management. He's contributing writer for Forbes and has co-authored the book Exchange Traded Funds, Conceptual and Practical Investment Approaches, something that I think I could use and many of us can use. We also have Stephen Weiss, BS 1977, who's currently a managing partner for Short Hills Capital Partners. He's a former tax attorney with 30 plus years of experience in the investment industry. He's a visiting teaching fellow at the University of North Carolina's Keenan Flagler Business School. And lastly, we have Sergio de la Garza, who is our webinar moderator for tonight. And he's currently an international student on campus, an MBA student, who's working as a graduate assistant in the placement and outreach office for Silverman. He's a member of the Student Managed Investment Fund, and he represents the Devils, FDU, on the court as a member of the tennis team. Thank you, gentlemen, for being here with us tonight. And with that, I want to pass the screen over to the four of you.
Thank you, Ken, for an amazing introduction. I'm looking forward for an exciting discussion, and I'm going to go for the first question. This is directed to Stephen, and is, are you bullish or bearish, and why?
Well, I'm actually cautious. So I'm sitting with more cash than I have had in quite some time. And the reason is that I lived through the inflation cycle in the 70s. And while interest rates are low and money is free, rates are going up. Money will still be somewhat free because rates will be low. But before the Fed can really attack inflation, they've got to raise rates meaningfully. And when you raise rates meaningfully, you slow down economic activity. So all the bullish Wall Street analysts are saying, well, yeah, but the economy is so strong, and yeah, companies are, reporting solid earnings and their guidance is good. Yes, that's right now. But as you go forward, the only way to get inflation down, as I said, is to get demand down. If you get demand down, it means you get growth down. We recently saw the University of Michigan consumer confidence was at 61, lowest it's been in 10 years. And my final concern is not really concerned about Russia, Ukraine. Typically on geopolitical issues, it's a buying opportunity. However, I'm worried about China and Taiwan. So they're going to sit back, China, and decide how far they want to go with Russia. But keeping in the back of their mind, they've said this, they want to go after Taiwan. So Taiwan is to China as the former Soviet USSR is to Putin. So they want to annex it. So whether war breaks out with Taiwan or not, that would be a major, major issue because so much commerce goes through Taiwan. For such a little country, they are really a technology hub for semis and for so much other technology. So those are my concerns. So with my seeing the risk reward basically in balance, I'm not getting paid to invest in the market to take the risk. So I'd rather sit in cash. If I'm right and the market trades down, great, I'll buy. If I'm wrong and I miss somewhat of the upside, that'll be fine too. But I just don't see the bullish scenario right now.
Great. Thank you so much for your great point of view on this question. And following to the next question, this is directed to John. If I had $10,000 to invest today, where should I put it, John?
So I just want to, before I get into that, I just want to pick up on what Steve's talking about a little bit. So when I wake up in the morning every day, the first thing I do is look where interest rates are. And right now, how Wall Street looks at interest rates is look at the 10-year US Treasury bond that yields 2%. About 3 months ago, it was 1.28%. So when I'm making a decision to buy or sell or do nothing, I always look at that rate as the key. And if I'm going to invest, I need to earn more than that rate. And and if I don't want to invest, that's fine. I can stay in cash and get a very, very low yield. The problem is inflation. So now last year inflation is somewhere between, let's just say 5 and 8% for a number. Going forward, some of the Fed governors think 2 to 3%. Typically bond yields are higher than inflation. So this is a very odd occurrence in our market. Vanguard came out yesterday and gave a whole prediction of how the market's going to be for the next 10 years. And they're talking about very low stock returns, less inflation, closer to 1% than the normal S&P average is 7%. So if I had $10,000 today, or if I had your $10,000, I search for individual stocks that are maybe a little bit more exempt from macroeconomic conditions than most. So I'm a bottoms up stock picker. So I don't want to give you the stocks because that's not what this is about, but there's lots of companies that are going to outperform the market. And those are the kinds of things I would put $10,000 in.
Great, John. Thanks for the response. And now switching up to, this is directed to Kevin. And Kevin, is inflation a permanent problem? Is it labor related or is it supply chain related? What do you think about this?
Yeah, it's a great question. It's certainly not transitory, as we were told during the majority of 2021. We saw in January that consumer prices rose 7.5% on an annualized basis. That's the fastest annualized rate of inflation in 40 years. We just learned that producer prices rose by 9.7% over the course of the last year, just falling short of a record. So inflationary pressures are going to remain in the economy, at least for the first half of this year, and hopefully they'll start to moderate over the course of 2022. Of course, a large component of that is what the Federal Reserve does or doesn't do. And as I continue to discuss, is the Fed's three-pronged approach for trying to combat inflation while trying to fulfill their dual mandate of promoting full employment and, of course, stable prices. So what's that three-pronged approach? TNT, tapering, narrowing, and tightening. And I think far too often, whether it's the financial media or individual investors themselves, they focused on the last T, the tightening. How many times are they going to raise interest rates and in what increments? But we also have to remember that they intend to end tapering. They intend to end their bond purchase program by the end of March. They also intend to meaningfully and significantly reduce the size of their balance sheet, as we learned from the outtakes of the last Federal Reserve meeting today. So what does that mean? Right now, their balance sheet is over $8 trillion. So they'll have some balance sheet runoff and potentially start to sell bonds off of their balance sheet. In addition, they're going to look to start raising interest rates, the Fed funds target rate. So that's a lot of activity in 1 year. And for all of those prognosticators out there who are now suggesting that the Fed is going to be so aggressive that we could see 8, 9 rate hikes this year, perhaps 50 basis point increments or more, I think we're getting a little bit ahead of ourselves. Let's see what happens in June when the first couple of rate hikes are put into place, when tapering is done, and when they start to actually unwind portions of their balance sheet. Let's see if earnings continue to grow. They're certainly not going to grow like they did last year. Let's see if the economy continues to grow. It's not going to grow as fast as it did last year. So let's just be, quote unquote, data dependent and see what this type of activity does to the economy and if it has a meaningful impact on inflation.
Great
Thank
response, Kevin. Thank you.
Sure.
There's actually a question in the chat from Alan Weinman. Alan would like to ask one of the panelists, do you expect the events in the Ukraine to raise the inflation rate to 10%?
Just the events in Ukraine alone, I think that might have more of an impact, as we're seeing, on energy prices with respect to US inflationary pressures. I don't know if that's going to have a direct impact in and of itself. If in fact there's more stimulus that comes from the federal government, that could certainly have an impact on inflation. And I'm still surprised that we're actually buying bonds and we're not going to stop that until the end of March. That obviously adds to additional inflationary pressures. But Ukraine itself, I don't know if that's going to push inflation in and of itself. But Steve, John, what do you guys think?
Go ahead, John.
Oh, good. So when you look at what's going on in the Ukraine, I mean, energy is a very interesting area, you know, and I come back to the whole problem of climate change and energy and how this whole thing's going to work itself out. But to Kevin's point, the data speaks, and I think that as rates go up, you're going to see demand drop so fast it's going to make the Fed's head spin. But we'll see. It's you know, this is futuristic. Right now, mortgage rates are above 4% right now. Now, I know my first mortgage was 13%, different era. But when a young person, and also the average mortgage size is $652,000, the most it's ever been. So I think once Gen Z realizes that, oh my God, my payment per month is going to be X, not Y, it's going to slow housing, slow demand, and inflation will sort of naturally abate?
Yeah, in terms of, I'll take it from the Ukraine, Russia standpoint. The popular wisdom is that it will raise inflation. It's tough to pick a point, like 10% or 9%. It's just tough to pick a point. And energy is a global commodity. And Ukraine does have significant gas reserves. Plus the threat by Biden that the pipeline to Germany for natural gas and oil will not go through. So you could see an increase in energy prices. However, you never know what OPEC's going to do. You never know what we're going to do in terms of raising it. But I think that part of the reason for the decline in the consumer confidence is concern about the war there. So it won't in and of itself, I believe, drive inflation. So I think actually it'll help tamp down inflation because the consumer, to John's point, is going to slow down as rates go up, and they'll slow down because war does things to people, right? And you're talking about a big power in Russia. As I said, then China's right behind it. But the interesting thing is that you're not going to be able, when the Fed raises rates, it doesn't mean that any rate increase is going to offload any more ships that are clogged at the port, or that they'll get more people, more, to take freight off trucks or rail cars. So that's the real issue. So you have this real opportunity where as you unclog the supply chain, there's one company I'm investing in today, GXO Logistics. We talked about some softening in the supply chain, not softening in terms of demand, but in terms of easing up on the pressures. So you're starting to see it, but not enough. It's still a real issue. So you potentially have this fire hose that's going to open when the supply chain unclogs. At the same time, you've got rates going up and demand coming down. So you could possibly be in deflationary situation, but that's sort of Armageddon. But the point is that I don't see inflation going much higher from where it is right now, and by the way, it's high enough. But keep in mind, for all the stock market, I mean, some people out there are talking about, well, the Fed's not going to let the stock market collapse. Well, of the NASDAQ stocks out there, half the NASDAQ stocks are down 50%. So you really have to ignore the indices because they rotate. The indices are comprised of multiple sectors, right? All the sectors, 500 stocks. The actual carnage to individual stocks and individual sectors has been incredible and something we really haven't seen. That affects the consumer psyche as well. When they're looking, and they're not looking to see what the S&P does, unless they're pure index players, they're looking to see what their other stocks have done. So all that to me hits demand. So I think inflation will get under control at some point because people just can't eat. 70% of the country lives paycheck to paycheck. And those are real increases. A lot of them don't own cars, but they all go to the supermarket. So we're in a very tough economic situation right now. And the headlines about how good the economy is and how many people are working just don't tell the full story.
Thank you for the response, Stephen. And coming back, you were talking about interest rates. The next question talks about if interest rates rise dramatically, what does it mean for me as a borrower, a consumer, and as an investor? What do you think?
I'm going to go to Kevin, who's the fixed income guru on this call.
I guess it really depends, Sergio, and thank you, Steve, for what your definition of significant is. Let's just go back to the last dot plot chart that we saw from the Federal Reserve, where they suggest 4 potential rate hikes of 25 basis points each in 2022. So we go up about 1% higher. But keep in mind that the bond market has already priced in between 5 and 6 rate hikes already. Look at the 2-year Treasury. It's moved up about 140 already this year alone. So it depends. Do we get 4 rate hikes? Do we get 5 rate hikes? Do we get 6 rate hikes? Regardless, interest rates are going to still be at record lows at the end of this year and likely are the next 2 to 3 years. So where do investors turn for income potential? Where do they turn for growth potential in that environment? So we looked historically at different rising rate environments. Generally, that's accompanied by expanding economies, because why would the Fed raise rates in a economy that's not expanding, right? Although they certainly have other times. So what benefits from those types of scenarios? Well, one area that benefits are banks, regional banks, community banks, mortgage and thrift institutions, the traditional spread businesses that benefits as rates rise and as the economy is doing relatively well. On the fixed income side, we still believe there's a good case to be made for municipal bonds. Consider that by the end of 2026, 1/3 of all outstanding municipal debt will either mature or be called. What's going to happen with all that outstanding debt? Will municipalities reissue debt to fund all of that debt? We don't believe so. And we also know that the demand for tax-free income continues to increase. And if personal taxes do go up, well, the demand will go even higher. Anytime you have an investment equation where demand is going up and supply is going down, that generally bodes pretty well for prices. We also like preferred securities in that environment for income as well. And of course, dividend paying stocks. In an environment where, as John suggested, that the return potential for stocks may be more limited now than what we've seen over the course of the last 3 years, when the S&P rose by, I believe, 72% over the last 3 years. If it's diminished and now we're getting single digits returns again, as I'm not going to give you my age, but I've been doing this for several decades right now. When you used to have a 6% return in the stock market, that used to be a good year. Now our clients look at us and act disappointed. But if you get those types of single digit returns again, dividends are going to become an even more important component of that total return equation. So we believe companies with good, strong balance sheet, free cash flow on their balance sheet, a history of growing their dividends, good earning strength, should be able to provide some good upside potential.
So one of the reasons I think you're all on this call today, or I'm hoping, is that we all need to find a way to retire someday. And this whole talk about investing, we all need to figure out in a very personal way, because I think it's a very personal decision, what assets, what investments make the most sense for us, that we can live the life we want to live. We don't have to eat in our principal, and we can enjoy our lives. This is a really, really tough time. So to Kevin's point, if you go back, and I know this is crazy, but you go back 100 years in the stock market, 50% of the market's return.
I haven't been working that long, John. 100 years is stretching. I said several decades, not 100 years.
True.
Kevin, so
You're
I
looking
was
at my
gonna
gray hair.
I was going to ask you about the buttonwood tree. You telling me you weren't there?
I planted it, Steve.
But if you look back, 50% of the market's return over time comes from dividends. So when you look at any high dividend paying stock that's consistent, because dividends are very sacrosanct. Companies hate to cut, they may cut buybacks, they're not going to cut dividends. So if you can find the right ETF, the right mutual fund, or the right individual stocks where dividend growth is higher than inflation, so your dividend grows at 14 to 20% a year, and there's plenty of stocks like that, those are the kinds of things, those strong companies that make it through any kind of market cycle. And that may be, and also, as Kevin said, preferred stocks are another great place where you may need yield rather than growth, because as interest rates go up, when you discount cash flows back to the present, growth stocks get killed. And then to Steve's point, if you're not long Apple, Amazon, Netflix, Google, and Facebook, and you look at your NASDAQ individual stocks, they are down more than 50%, many of them, all these high growthy, next generation stocks. Look at Roblox yesterday. I mean, there's the stock of the future down 20% in 30 seconds on, metaverse concerns, whatever the heck the metaverse is. So I think if you're picking individual stocks, you've got to be a little bit more conservative. And as rates go up, fixed income comes back into play, where we don't want to buy 1% instruments or negative yielding instruments, but at 5%, 6%, 10%, I'm all in on that.
I would just add that it's very, very difficult to pick stocks, and most people shouldn't. As a matter of fact, one of the hedge funds that we were invested in, I said to the GP, I said, "Where are you putting your kids' money?" And he said, "I'm putting in the S&P index."
Mm-hmm.
And, at the age, of, I think a lot of people on this call, younger people, just put it in the index. Don't try to time it. Forget what I said about what I feel about the market. Just constantly put it in there. and your money will compound. And that's how you get wealthy. You compound, you don't trade stocks. And as I said, picking stocks is, for the best, the win percentage is only about 60, 66%. So it depends how they size those positions, their conviction level. Keep in mind, they're talking to the companies all the time. They're reading all the filings, the SEC filings on Edgar. They're listening to the conference calls. They're looking at what the indications are. I had a call with a CEO yesterday. I said, what should, the CEO of Cliffs, and offline I said to him, so what are the indicators for your company? What should I look at? And I'm asking that question, and I had access to the CEO. So for the average investor, they just don't. I'd also say this, you got to be careful of some high yielding stocks. If a company's dividend is 10%, the yield is 10%, there's generally something wrong. And that 10% is not going to be sustainable. So when you have a yield in the S&P that's, what is it, John? 2 and change?
1.75.
Okay, so that's your baseline. So if something's yielding 5, well, then maybe something wrong. The final thing I'd say is buying a stock, and nobody's suggesting, John didn't suggest it, Kevin didn't suggest it, buying stock just because the yield is attractive is the wrong thing to do. Because when you take a look, Roblox, not they have a dividend, they don't, but Roblox was down 20%. If it had a 5% yield, it's going to take you a year to collect that 5%. In the meantime, the stock's traded down 20% in a day. So even stocks, you look at IBM, you look at GM, did away with their dividend, and they had a high dividend. So just because stock is a high, and I will say this again, I know I'm repeating myself, it has a high yield or even a yield above the S&P at 4%, don't buy on that basis. The fundamentals have to be there. The cash flow has to be there.
Yep.
Absolutely.
Yes, absolutely. There's some questions in the chat. It says, if it typically takes 4-6 months for interest rate hikes to be reflected in the economy, what is the rationale for multiple rate hikes in a short period of time without having the ability to see any reliable impact reflected in the data? What do you think?
I think it's a great question.
Yeah, I think it's a great question. I think we all assume that there's some science behind what the Federal Reserve does and the immediate impact that it has ultimately on the economy. Essentially, they can do one of two things, right, guys? They can buy bonds, they could sell bonds off their balance sheet, or they could raise the Fed funds target rate, and then everything else sits off of that key lending rate. But they don't have a magic wand that they can just wave and inflation goes away. There's many other reasons why we are seeing these record levels of inflation that we're seeing right now. Part of that was because we need to stimulate the economy off of the doldrums that had hit in March of 2020 at the beginning stages of the pandemic. But unwinding that is often much more difficult than it is when you become into the market to become more accommodative. So I don't think there's any exact science to understand what happens and when it should happen. All I can tell you without a crystal ball is that we're in a rising rate environment, right? The economy is expanding, but it's starting to slow now. We had a good retail sales report that just came out, but consumer confidence is weakening, as Steve suggested. So where does that leave the US economy in the face of rising rates, recognizing that the consumer accounts for 70% of GDP in our country? Those are all things to think about as you're making your investment decisions.
I'll tell you what I think. I think if the Fed could raise rates by 100 basis points, they would, but they can't, because that would just say that we're in crisis. Right. So that's what they'd like to do. I'm sure if you caught any of them off the side, say, I'm not going to attribute this to you, I'm not even going to repeat it. I'm just curious, where should rates be today? We're no longer in an emergency situation with COVID or 2008, but yet you're at emergency rate levels. It's also not looking at the absolute yield of 2% in the 10-year right now. It's where have they come from? It's the rate of change also that drives it. So if you were benchmarked at 1%, now you're 2%, well, your cost of capital, right, has gone up, has doubled. So it's meaningful. So when people say, well, we're still going to have historically low rates, everything's great. Well, it's not, because people have budgeted whether it's individuals with their personal budgets or whether it's companies in terms of their cost of capital. They've put a number in there. Now they've got to adjust to it and say, is this still a profitable venture? Or for the individual, can I still afford, to John's point earlier, to pay this mortgage? So those are the deltas. So it's going slow, not to panic the markets. And when you hear that, oh my God, 50 bips, right? And people are worried about, can you imagine if they got to where they should be tomorrow, with 100 bips? No. So the other thing is they don't have enough in their toolbox now if the country goes into recession. There's a report that I read that when Yellen was there, that her staff wrote and said, we need to get to 5% rates in order to have enough in our toolbox to combat a recession. So we're sort of on borrowed time. And just to Kevin's point, it's not where the 10-year is. He alluded to the spread. It's where the spread is. And that's why you buy banks. So if the spread between the 10-year and the 2-year, or anywhere you are in the yield curve is spacious, right? If the range is wide, that's how banks make money. If the curve goes the other way, trends the other way, and it inverts, which means that near term, shorter term borrowing is higher than intermediate or longer term, supposedly that's been a recession. As a matter of fact, it's happened, 50 times. It's predicted 9 of the last 0 recessions, whatever. It's not a great indicator, is my point. So, but those are all things you got to be conscious of.
So here's another problem that, we wouldn't normally think about, but take a company like Netflix, great company, last earnings, not so great. No one really realizes they have $16 billion worth of corporate debt on their balance sheet that rolls off over the next 3 to 5 years with an average coupon of 1.5%. Now, for Netflix to keep giving you all that good content you like, they're going to have to come back to the bond market and raise another 16 billion. Now, if rates are at 2, 3, 4, 5, 6, or if their credit is not as good as it was, all of a sudden their gross margins are going to go way down. So back to Steve's point, when you're looking at individual stocks, there's lots of little stuff in these things that make investing in companies like that in a rising rate environment very difficult. So stick to the S&P.
Great. There's another question. It's Casey, the student from the Metropolitan Campus. He's asking a question about an individual stock called Beyond. I think it's Beyond Meat. They make Beyond Meat. They make alternative protein products. He's asking if he thinks it's a fad or do you think it's here to stay. Right now, it's in a low, about 50% from its 52-week high. But what do you think about this stock?
First of all, embedded in that question is a very interesting question, which is that just because stocks are down 50% doesn't mean they're any cheaper. As a matter of fact, they could be more expensive because the earnings could be down 50%. So if the earnings down 50% and stocks down 50%, arguably it's the same value. So you can't buy stocks just because they've been crushed. You got to look at the fundamentals and see what's happened to the earnings and the earnings projections. And also, if there was a momentum factor to the stock, right, that makes it more attractive. So I would argue, for example, that Meta or Facebook, as John, Kevin, and I are always going to refer to it as, is a more expensive stock now than it was. Now, in terms of Beyond Meat, I don't eat meat. I don't eat chicken. I'm pescatarian. I eat some Beyond Meat products. However, it was always an expensive stock, and there's no moat around that business. Lots of other companies are making those products too. So you've got to look at it on that basis. So I don't think it's a fad. I think that people are less inclined to eat meat now. Plus, meat's gotten extremely expensive, so fewer people can afford to eat meat. But I'm not going to opine on whether it's a value here or not. I haven't done the work on it. Bought their products. I'd recommend their hot sausage product. It's excellent. But aside from that, I just can't offer an opinion on Beyond.
So just about, we were discussing Beyond Meat with one of my classes today, and it's an interesting product. They have a deal with KFC. They're doing a test with McDonald's. But the funny thing about Beyond Meat, even at these prices, it's down from like 170 to 61 today. It's the most shorted stock in the NASDAQ. It's 34% short, which is more than AMC, more than GameStop. This is the one where hedge fund types are going, it is a fad. They're not going to earn. They're not going to get the McDonald's contract. And guess what? Earnings are coming out next week on the 24th. So Casey, we will see fireworks then, either up or down, depending on how their earnings are. And we'll see if the smart guys are right.
Yeah, I wouldn't buy it, by the way. If the stock explodes higher, it could be a lot of short covering fueling that. I wouldn't buy it. It could be Angry Cat or whatever the guy's name is on Reddit driving it. You know, it's just either you got to buy into the fundamentals and prepare to stay there for a long, long time, or just stay away. It's very difficult to analyze those stocks. You know, you just have to be literally talking to each supermarket and saying, you know, what are your sales? Are they up or down? You know, who's buying more? You know, I used to, there's a guy, Steve Mandel, who was a Tiger management that I used to cover, did retail. And he would pay people to go to malls around the country and take a look at the shopping bags they were bringing out when brick and mortar was still a thing. I don't know how many people on this call remember brick and mortar, but, you know, see what the traffic is. Those days are sort of gone now. You can scrape the web, get information, but it's difficult. So my personal view, I'd stay away from Beyond.
Yeah, I don't follow the stock, and I do eat meat, but I'll add an anecdotal story just around rising meat prices in general that I think you'll all appreciate. So I have a good friend who owns a poultry business in Paterson, New Jersey. I call him Chicken Vin, appropriately so. So every time I hear that there is a shortage of poultry or that chicken prices are going up and skyrocketing, I call my eyes and ears on the ground. I call Chicken Vin. Chicken Vin told me that there's no shortage in chickens. There's no shortage in poultry right now. You know what there's a shortage of? Labor. There's a shortage of people to drive the chickens to my plant. There's a shortage of people to process the chickens. There's a shortage of people to serve the chickens at the restaurant. And there's a shortage of people to stock those chickens on the shelf. So I've always contended throughout all of these supply chain related issues that a large number of them can trace back to labor supply shortages. And if in fact more Americans are going back to work, if you believe some of the recent surveys and studies and data releases, that could be a good sign to help ease some of those supply chain issues. So don't have an issue on Beyond. I don't have a thought on the stock itself, but I thought you might appreciate that anecdotal Chicken Vin story.
Definitely. Yes. Now I want to go to another topic that's very, very hot right now. Cryptocurrency, NFTs, do you think are a fad or disruptive? What do you think?
I know what John thinks. I think I know what Kevin thinks.
Do you want to go first then, Steve?
Go first, Steve.
Yeah. It's not my thing. You know, you sit back and you laugh, and we've seen these things before. And, you know, one person buys the first NFT for 40 or 60 million and say, okay, that person should be committed, or has way, way too much money. I just think it's fad. I don't think it's real. And I mean, it's real today, but I'm also not a big proponent of Bitcoin. The volatility will always prevent it from being currency, in my view. Blockchain technology has been around for a long time. They didn't invent it. And to think that we're going to have this currency that the world's going to gravitate to because some guy that we don't know named Satoshi something invented it and said, hey, this is the world's next currency. That's not happening. It's not happening with NFTs. So you can say we're old school. That's always the defense. No, you guys are too old. You don't get it. This is today. Yeah. I've seen so many of that. You know, I used to say that actually, that you guys were too old. And then I found out they were right, those guys. So that's how I still feel. So no, I wouldn't waste my time on that.
Yeah, obviously I'm in lockstep with Steve on that front. I have a real tough time explaining an investment if I can't put my arms around the valuation for the investment, or at least have a reasonable explanation as to why an investment would move in one direction or the other. To prove I'm not that old though, I do see investment merits in the blockchain technology. In fact, we've invested in a couple of companies that we see growth potential in. Riot Blockchain, Marathon Digital are a couple names that come to mind. So the technology itself, which has been around for decades, which IBM has actually been employing for a large number of years. Yes, Big Blue, IBM. I do see incremental benefits across multiple industries with the blockchain technology. So that I can put my arms around valuation wise, but cryptocurrencies, NFTs, I'm not there.
So I always ask my classes, explain cryptocurrency to me. Oh, we're all long it, yada, yada, blah, blah, but they can't explain it. Do you all know there are 16,000 different cryptocurrencies? It's not just Bitcoin. There are 16,000 of these things. And most of the trading that goes on in them are with people who own these things. So it's not the universe of investors is not widening out for crypto. To Steve's point, is it a currency or a commodity? So I say it's a commodity, not a currency. People don't use this thing as a currency. And then you jump over to NFT. I mean, I could be Charlie, who's Buffett's partner?
Munger.
And say it's all rat poison. I'm not going to say that. But then you jump over to NFTs. And what's happening in NFTs now is that people who own NFTs are selling to each other to jack the price up. There's no regulation. It's like the wild, wild west. There's no tax consequence. It's a very scary, speculative area. So now the Chinese are going to have a digital currency. We're going to have a digital currency at some point. What then is the point of cryptocurrency? So we'll see. Is it going to get outlawed? We'll see. But again, not for me either. And all my kids disagree with me. So, I'm old and I get it.
Dan, thank you for your outlook on this. This is certainly a hot topic right now. Now, I want to switch to another question. I want your perspective on this. So what is the worst mistake you have ever made in investing? I know we learn from mistakes, so I want to know what's the worst mistake you have ever done?
We got to pick just one?
Yeah.
Well, no, it could be whatever you want to share. Definitely.
We're going to have to extend this webinar for a while. I've got a feeling. I'll kick it off. I mean, the worst mistake is, I guess, thinking I know more than the market, or more than what things are telling me, and to let ego or emotion get involved. So when I've lost money in a stock, sometimes I've gone back and bought that stock, and now what I do is I take it off my screen. I just don't want to see it. I don't want to be tempted anymore, and that's opposed to my biggest loss, which I think was probably in Boeing, believe it or not, which of course was management's fault. I had nothing to do with it. But it's buying what shouldn't. I'm not a momentum buyer, but occasionally gets sucked in. It's buying momentum, but it's the biggest mistake anybody could ever make is violating their discipline. Yeah. So no matter what kind of investor you are, you need a discipline, and you map that discipline out and you keep it. And I used to keep the key tenets of my discipline on my screen, even 20 years into the business. And you always look at them and you just don't violate them. And you should keep a notebook. And I used to do this of the mistakes you've made so that you can go back and look over them. But that's what it is. Define your strategy, define your discipline, and don't ever void it. You'll miss some things, but it'll save you a lot more money than you'll miss out on.
Yeah, and I'll just add on to those comments as well. Henry & Walsh started in 1990. I worked for Lehman for 11 years. I think, Steve, you worked at Lehman as well. Yep. I joined Henry & Walsh in 2004, became their president and CIO. And at the very beginning stages, we were very tempted in meetings with prospects and clients to go beyond our discipline just to win new business, whether it was a foundation, a pension plan, an endowment. When we were given restrictions, for example, let's say we were meeting with a large pension plan and they told us that they didn't want any international equities in their portfolio. And we had a strong thesis and belief in international equities through an exchange traded fund or whatever it may be. and we would cave to our discipline to allow that restriction. Now, 18,000 accounts later, we don't necessarily cave to those restrictions because we stand behind our core convictions, our discipline, our process, and obviously our track record. So I think, the biggest mistakes I've made, and I've made them time and time again, not just with respect to where to allocate assets, what stock, what exchange traded fund, but more so just relying and staying true to your own expertise and your own discipline. And I think everyone on this call who's an investor can learn from that as well. In other words, when the market is going up, that doesn't necessarily mean you get more aggressive. When the market's going down, that doesn't necessarily mean you get more conservative. Stay true to what your risk tolerance is. Consider your longer term investment goals and objectives and build discipline into your own processes so that you don't try and time the market. We all know trying to time the market is often an exercise in futility, and I certainly can't do it. And I've been doing this since the buttonwood tree was planted, as Steve alluded to.
I'm going to give you an actual example of the dumb things I did along the way. But to both these other guys' points, patience. The only way you make money is if you're a long-term, patient, and introspective person that reads a lot about the S&P, the companies, the economy, and all that stuff. Anyway, my first trading job in 1980, I'm making $11,000 a year, and I got a bonus of $11,000. And I said to my girlfriend, now my wife, honey, I'm putting it all in this penny stock. We're going to be rich. That's it. And within 6 weeks, it was zero. That for me, was like this aha moment, like, what a dumb thing to do. Second dumb thing, 1982, next bonus, I bought 2 shares of Berkshire Hathaway Series A, $800 a share, 1982. Sold it when it was at 5,000 a share. Dumbest thing I ever did. So those 2 things have formed my philosophy as this patient, don't act, know what you're doing, have a few sectors and then just let it all ride. So thank God it happened when I was young and not, now that I'm old, not now.
Thank you for the great comments on this. I want to ask another question. Some of us who are starting, it's difficult. A lot of friends tell me oh, I want to invest, but I don't know where to look at it. I don't know where to look for information. I don't know where to start. So what do you think? If I'm just starting off, where do I go to get my information, or who do I go for?
Well, John and Kevin are going to give you their personal cell numbers after this, so you can call them anytime, day or night. Look, I mean, there's so many resources out there. You start by reading the journal, read Barron's, Bloomberg, if you can get it. I mean, it's an embarrassment of how much is out there, but it also can be confusing. You can't read everything there is. But I'd say that it's much more important to be on top of the economy and the trends that are out there than it is, again, to buy individual stocks. I mean, individual stocks, the place you go is, I know some firms. There was one guy, Marsico, and he refused to let his analysts read any Wall Street research at all. All he wanted to do was talk to companies and look at SEC filings. And that was when companies told you something. Companies don't tell you anything now because of Reg FD, which is full disclosure. So it used to be, if you were a big shareholder, you'd get that call from Coca-Cola first telling you, hey, we're going to raise our earnings forecast, we're going to lower it. You can't do it anymore. So you need your own sources. And I would just say, you see what the track record is of some of the best hedge funds out there, some of the best long-only managers out there. 75% do not beat the S&P on a day-to-day basis, on a year-to-year basis, right? So why kill yourself? Go out and, apply your trade, learn about your industry, and, make your success there, and just buy the indexes and leave the investing to Kevin and John. That's the way to do it.
It's a great point, Steve. But only thing that I would add to that is also challenge yourselves to to read articles and follow authors that don't agree with your viewpoint. You know, I challenge our investment committee to also look at the naysayers, the perma bears as well, because if we just put blinders on and only read those authors or follow those websites that generally tend to purport or agree with your own investment style, you're not going to get the best information and perhaps miss something. So we follow multiple authors on Seeking Alpha. I still read Barron's on Sunday. We look at Market Watch, we look at CNBC, we peruse through the headlines, and then we drill down into certain articles that we think might be helpful to us. But mostly we're looking at economic data points as opposed to opinions so that you can form your own opinions. But yeah, I agree with everything that Steve just said.
Yeah, I don't read Barron's either, to tell you the truth. I haven't read it for 20 years. And anytime I take a position in a company, I do exactly what Kevin suggested, which is I want to know where I can go wrong.
Yes.
You know, I've figured out the upside. That upside will take care of itself. I want to know what's going to hurt me. So, you know, there are analysts that are out there in the street that have purposely, if the earnings estimate is $1 consensus, they'll have $1.50. Maybe another one will have 50 cents. And those are the ones that you want to call. Now they're doing it to get your call. So you vote for them for II is a different story. So they're exaggerating their position, but those are the ones you want to call. Why are you up so high or why are you down so low? You don't want to call the ones that are in the middle. They're not going to tell you anything.
So just two things to add. You know, I don't think using apps like Robinhood are great for getting into this. I think you need a person to talk to walk you through what it means when you buy anything. Fidelity's fine, it's free. Schwab is fine. You want to be a little bit more upscale, go to a place like Morgan Stanley, which offers, or Hennon and Walsh, that offers lots of different products. And you get a team of people that, you know, look after your needs. You need to know what your needs are, though. You need to know what your objective is. And pretty much for all of us, it's how do we get to retirement and not eat into our principal. One book I would recommend, my mentor wrote this book. It's called The Most Important Thing. It's by a guy named Howard Marks. It's about risk. It's not about stock picking or those kinds of things, but literally it's about how we all think about risk and how much risk we can take when we're investing. So it all comes down to greed and fear and risk and reward. And you got to know your own psyche when you're buying Beyond Meat or an ETF or whatever. You got to know that you can sleep at night. And if things go up or down, it's not going to really upset you. So I have this book. I think he wrote it about 20 years ago. He writes great newsletters. It's on my nightstand. I look at it at least a couple times a week. It's timeless and it's common sense.
Thank you so much. I just want to thank everyone, the panelists, for an amazing conversation. I'm sure it was excellent for all of our listeners here. I think it was for me, definitely it was. I appreciate it so much. And I just want to pass it to Mary. She's going to say some couple words here.
I want to thank the panelists as well. You guys are rock stars. Steve, John, Kevin, you've made FTU so proud. And that was excellent. And Sergio, thank you. You did a great job too. So very, very happy. Can I share my screen?
Sure. Go ahead, Mary, give it a try.
Okay. So just to add to Sergio's last question, if anybody is interested, students, alum, in hearing more about how the markets are doing and about investing, you're in luck because every Tuesday we do a markets update with John Budish. And it is in our Bloomberg lab on the Forum campus and the Metro campus, but you can also join via Zoom. And I can put the chat or you can take a picture of it, but it's every Tuesday from 3 to 4. Again, markets update with John Budish. We have special guests. Hopefully we'll get Steve and Kevin to come one day. And you can follow us on Zoom. We also have from 4 to 5 a student managed investment fund. And that's where students actually pitch stocks. And the dean has kindly donated $100,000 for the students to invest. So if you're any interest in that and listening and helping out, you can join that as well. And if you have any questions, just let me know. But Thank you, everyone. Jen, I'm gonna hand it back to you.
Thank you, Mary. And all I have to say is, wow, what a great presentation. The panelists, absolutely fantastic, with a wealth of knowledge. And we thank you as alumni of FDU coming back and sharing that wealth of knowledge with everybody this evening. Thank you so much. I want to thank everybody again for attending tonight's webinar. Please be sure to visit us on support.fdu.edu. That's where you can find alumni news and updates, upcoming events, and more. And speaking of more, quite a few people had asked in the chat tonight about a recording of tonight's webinar. So this has been recorded, and we do share the recordings of our webinars, usually within a week. So if you check out support.fdu.edu, we will have a recording of tonight's presentation on there. And again, if I know there were some questions in the chat that we didn't get to, if you really would like them answered, please feel free to email fdualumni@fdu.edu, and I will forward them to our presenters, and they did agree to respond to any questions that they got in regarding tonight's presentation. I put that email in the chat, so check it out there if you need to get it. And again, thank you all to the presenters. Thank you, Mary, and your team over there in Silberman, for helping make tonight a success as well. And everybody have a great, healthy, and safe evening. Bye,
Thank you.
everybody.
Bye, everyone. Thank you.